Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
Ooh, okay. Ooh, finally. Okay, so first start of the workshop is I'll just finish the lecture slides. So I finished here. So the next slide is cost of debt. So in the lecture on Monday, I talked about the WACC, the weighted average cost of capital. I talked about how to get the beta, which risk-free rate to take, what the ERP should be. I gave you that information. So what we're left with is we have to calculate the weights. That's not too bad. And cost of debt. Cost of debt, it's quite interesting. So cost of debt, which is the KD in the WACC calculation. So now we're talking about, we talked about this. We talked about how to estimate this. We still need to talk about KD. The tax rate is 30%. That's no problem. And we still need to talk about the D and the E. Luckily, that shouldn't take long. So let's talk about the KD. Let's talk about this cost of debt. Cost of debt, ideally, you want to use the company's own cost of debt. 95% of the time, the company does not tell you what the cost of debt is. JB Hi-Fi is one of the 5% that does. Surprisingly, I've seen it when we valued so many companies in this course. I think JB Hi-Fi and one more, I think it was Dulux, I think, they actually told you what their cost of debt is. Amazing. But usually companies keep that secret. They don't have to disclose it, so they keep it a secret, but no, I don't want that. Oh, Explorer, scary. So if you go to the 2018 report, I didn't read all of it yet, but look at what I saw in note 20. Voila, there we go. So the company actually told you what their weighted average interest rate is, 3%. That's amazing, 3.01%. That never happens. Companies rarely tell you what their cost of debt is. And on any swaps that they entered into to hedge interest rate risk, it's very close. So if you use 3.15, which is the higher of the two, that sort of makes sense. If you use 3.01, that's also correct. So either of those two will work as your cost of debt for JB Hi-Fi, right? And that number, of course, needs to go to the KGW model. So it's going to be a very low number. But it has to go to the KGW model in your WACC tab. In your WACC tab, as your cost of debt, right there. Right, so 3.15. As you can see, the after-tax cost of debt is very small. This is why I have a problem with low interest rates. It's very easy to grow an economy, very easy to grow a company, very easy to have a profitable company when money is this cheap. It's so cheap. 3%? That's insane. That's so low. So, all this is why I sold all my equity because I think stocks are overpriced. Because of course stocks are doing well when money is this cheap. Right, it's called the debt supercycle. I posted a Waddle article on the debt supercycle, which talks about re-leveraging after a crisis like we had a credit crunch in the 2008. When you come out of the cycle and debt is really cheap, everybody starts borrowing like crazy. And that just creates a bubble because prices go artificially up because everybody's borrowing and money's so cheap. That's unsustainable. It's unsustainable. So I'm very skeptical, but hey, borrow, see what happens, right? But yeah, for JB Hi-Fi, yeah, very small. So let's imagine that, try to be more realistic and imagine that JB Hi-Fi does not tell you the cost of debt. It's possible, it's very possible. bless you, what can you do? Right? So if the interest rate's not quoted by the company as it is here, there are other things that you can do as an analyst to estimate the cost of debt in your WACC calculation. One of a very accounting approach, but that doesn't mean it's wrong or anything, it's just backward looking. An accounting approach would be, an accountant would tell you, what's the big problem? You have the interest expense in your income statement for 2018 for JB Hi-Fi. You knew how much debt they have a year ago. So this is T and this is T minus 1. All right, they pay interest on how much debt they have. Just flip it around, interest rate, because the interest expense is just equal to how much debt you have multiplied times the interest rate, right? Well, you can solve for the interest rate by just taking that to the left-hand side and just having interest rate is equal to the interest expense for the year, so that's 2018, divided by the amount of debt you had at the beginning of the year, so end of 2017. That's correct. That has to hold, bless you. So that's one way you can do that, and nothing wrong with that. Yep. No complaints. It's just the only problem with it is backward looking. So if you don't have stable interest rates, that's a problem. But in Australia, we have stable interest rates. In my opinion, they're artificially low, just like all over the world, but they are likely to remain artificially low for a while. So at some point, they will go up. They won't go down anymore. Thank God we have a reserve bank that is not crazy. It's just only a little insane. Interest rates will go up once inflation picks up, but for now it looks pretty stable. So that's one thing you can do as well. And try to do this for JB Hi-Fi just to check that the 3% makes sense. You should do that anyway. It doesn't matter that the company told you the percentage. You should do this analysis anyway. So this takes two seconds to calculate. You should do that even if you don't use it, you should do that in your analysis. Next, any interest rates that other analysts use. I gave you reports for JB Hi-Fi. Well, go to the analyst reports in a table. They should probably say what interest rates they used. If they didn't, fair enough. And this is probably the best. This is forward-looking, not backward-looking like this. So the benefit of this is forward-looking, and the approach is just using the credit rating of the company. So the credit rating agencies, let's be clear, are horrible, horrible, horrible companies. Yeah. Like scumbags. Like they should be in jail bad, right? Really, I mean, these people are what's wrong with the financial system, right? So let's talk about these scumbags. So there are three rating agencies, S&P, Moody's, and Fitch, right? So credit rating agencies. There's a few other ones, but those are the main ones. They're called the big three, if you like. Very creative. Down here somewhere, I'm on the wrong page. Credit rating, maybe credit ratings. Let's just do credit ratings. Credit ratings. Where's the table? I want the table. There's the table. That's not a good picture. That's better. Yeah. So there are three credit rating agencies, S&P, Moody's, and Fitch. S&P is the largest, Moody's is slightly smaller, Fitch is the smallest. They all work the same way. They all have their credit ratings based on the credit risk of the company that they're rating. The problem here is, this is where the scumbag comes in, these companies are private companies. They're not government agencies. They're private companies, and if you want your credit rated, you as a company have to pay these companies to rate you, which creates a massive conflict of interest, right? If you're paying them to rate you, they are likely to give you a good rating because you're paying them so that you come back next year for another rating. And you keep coming back and back because all they care about is a private company. The job of a private company or a public company, any company, is to maximize profit. You maximize profit by maximizing fees. It's very easy. It's not complicated. So what do you do when somebody comes to you, rate my credit, rate my bonds? Give them a high rating. So they come back next year. And if you don't give them a high rating, okay, you gave me a okay rating, I'll just go to Moody's, right? So because there's more than one, there is a choice that companies can make, so they'll go to the one that gives them the highest ratings. The companies know that, so they all give high ratings, right? So that's a huge conflict of interest. So Buffett won't touch credit ratings. He publicly said, the largest investor in the world will not touch credit rating. The largest fundamental investor, what we teach in this course is fundamental investment and fundamental valuation. The guy who's known for that will not touch that. I wouldn't touch that. These are wrong, for lack of a better word, right? So the only reason why they survive is there's no alternative. There's no government that says, okay, these are bad. They all know it's bad, but it's too much work or it's too expensive to do it ourselves. There's a bunch of academics out of the University of Singapore that have created a very simple and intuitive and very good formula to calculate distance to default using a formula that you can use. It's available online. Do not use it but in this course, but if you always want to calculate an unbiased credit rating, you can go to the website. I think NUS, National University of Singapore, has credit ratings for most companies that are public around the world. It's global, and it's free. Right? It's freely accessible information. And they give you the formula as well if you want to do it yourself if they don't provide the credit. So they'll calculate the credit rating for you, and if there's a company that they don't provide, they give you the formula for free, and you apply it. That's good. That's unbiased research. That's unbiased analysis. The S&P, Moody's, and Fitch, that's not unbiased. That is biased. Yeah, it's a huge conflict of interest, right? So if there is a credit rating, we can use a table that looks like this. Even if they're bad, we can still use it and just know that it's bad. So there's, as I said here, there's a huge conflict of interest when you use these credit ratings. So imagine S&P or Moody's or Fitch gave you the highest credit rating, AAA. That means your risk is the lowest. The probability of default is 0. And your interest rate should be the risk-free rate, the government rate, plus a spread of 0.88. This table is in the alternative textbook, which is available. Actually, Damodaran, the author of the alternative textbook for this course, provides all his textbooks for free online on his website, so you can have a look. Or you can come to my office and borrow the textbook, but this is where I got that from. He calculated the historical spread. This is the column that you need, the historical spread above the government yield for each credit rating class. Right? So that's not bad. Analysts do use that. They use the credit rating that one of these three companies provides, and they look at the risk-free rate, the government rate, which is, remember, about 2 for Australia. What was it? I showed you in class, 2.6. You should probably use the shorter, the 5-year, because debt is generally not a 10-year like equity, a 10-year point of view. If you use the 5-year government rate, I'm not going to bring it up. I showed it to you in class. Let's say it was 2.5. I think it was like 2.4, whatever it was. For a 5-year government bond, the nominal rate, the current yield, about 2.4. Add 0.88%, you'll get what, 3.2, 3.3? That's very close to the rate that JB Hi-Fi tells you, right? So it all sort of looks like around that mid-3, low-3 percentage that you should be using as the cost of debt, your KD, in the WACC calculation. Obviously, if the company that you're rating as an analyst has a different credit rating, the lower the credit rating, the higher the spread. Right? It makes sense. Right? So if a very risky company rated CCC, for example, that's very close to default, probability of default is quite high, that should be 11% above the risk-free rate. You should have as a cost of debt, right? 11.25. D means you're in default, so your bonds are worthless. So that's one way you can do. The last thing that analysts do that also makes sense to me, I really like this approach, is just use a ratio. I mean, we live in it's not complicated. We have a lot of data these days. Just use the interest coverage ratio. Interest coverage ratio is just EBIT divided by interest expense. And that ratio really answers the question, how many times can I use my profit before tax, because interest is paid before tax, to pay my interest expense? Imagine EBIT is 100, interest expense is 10 million. I can pay off my interest expense 10 times with my profit. That's pretty good. So any coverage ratio sort of 10 and above or 10.5 and above, you're quasi, if you like, you have the highest credit rating or AAA credit rating. When you calculate credit ratings using the interest coverage ratio, it's called a synthetic rating, because the rating doesn't exist, so you recreate it synthetically by calculating this ratio. For JB Hi-Fi, I think they're at 10. They tell you in the presentation and in the annual report. I looked at it last night. It's somewhere here. Let's go to the presentation. So the companies reported as well. Interest coverage ratio, whoa, 21. My mistake. Yeah, that's huge. That's very good. That means they can use their profit 21 times to pay off their interest expense. That's very good. That means they are basically no problem paying off their debt. Because remember, a company only goes bankrupt when it cannot pay its debt, its interest expense. It will not go bankrupt if it cannot pay dividends. Dividends, it's not required to pay dividends. Dividends can be cut all the way to zero. The company is not legally required to pay dividends. So it will continue, it will not go bankrupt. But when you take out a loan, you sign a contract, you're legally required to pay interest. So if you cannot do that, you go bankrupt. Right? In our case, the interest coverage for JB Hi-Fi is very high. Yeah. So no problem there.
So this ratio is biased or biased?
No, unbiased. Because it's a simple ratio. EBIT has to be correct, otherwise your income statement is incorrect. Interest expense has to be correct, otherwise your interest expense is your income statement is incorrect. So if your income statement is incorrect, which is a legal problem, of course, companies cannot lie on their income statement. They have in the past, and companies sometimes go bankrupt when they do. So it's an unbiased ratio. Yeah, that's why I like it. Yeah.
So actually, we don't need to look at the formula used in the website.
That's right. So NUS is the university that provides that formula, a distance to default formula. You don't need to, no. It's just, remember, in forecasting, we're predicting the future, so we don't know. So that's why the good idea as an analyst is to try a lot of things and see if they all give you the same number. If they all sort of give you, for cost of debt, around 3%, 3.5, 3.3, 3.0, 3.1, 3.15, then you should know that the cost of debt should be somewhere around 3 point something, 3.2, 3.3, something like that. When a company doesn't tell you what their actual interest rate expense is, which almost never happens, but JB Hi-Fi does, right? So yeah, that's my preferred method is if I was an analyst again, I would just be looking at the interest coverage ratio because it's a ratio, it doesn't lie. It's a simple division of two numbers. There's no analyst, there's no bias, there's no conflict of interest. Yep.
Yeah, like when you are like forecasting like future interest expense, but the historical ratio is like a huge fluctuation. How can we select the historical?
Yeah, it's a good question. So the question for those listening is, the lady has asked, there's a fluctuation in the interest expense, right? The ratio, that's correct. A lot of debt is issued on a float. The coupons are fixed, but the yield is not fixed, right? So it does fluctuate. That's a good point. When companies operate in an environment that is not stable in terms of interest rates, that is a big problem. Australia is not one of those. Even if there was fluctuation, so they borrowed, a lot of their money comes from Australian banks, but also a little bit from overseas. The overseas exposure, they're actually hedging using swaps. So even swaps don't last forever, that's true. They last for about, depends, it's a private contract, but maybe 5 years. 5-year swap is sort of, it varies. JB Hi-Fi doesn't tell you the length of their swaps. But there is some variation. But if you're forecasting in a very stable interest rate environment where inflation is not a problem, so the central bank is unlikely to keep increasing or decreasing interest rates, you can be quite confident to use a static rate. If you are forecasting in a country with a lot of fluctuations in interest rates, that's a big problem. Your forecast becomes more subjective. What would you do? You would do, as an analyst, you would have to see, you would have to read, you have to go into so much detail, you would actually have to see, go into the central bank report and see what their outlook on interest rate is and factor that into your prediction. And if interest rates are going up, then you have to forecast interest rates going up more. So yeah, you have to make a judgment call, a forecast of some kind. For JB Hi-Fi, we don't really need to do that because interest rates.
But here you can see the interest coverage ratio in 2017 is 28, but in this year is 22.
Yeah, if it's a, that's correct. So the reason for that is, good guys, which is an acquisition that JB Hi-Fi will probably not repeat. I mean, the company had a huge artificial growth because of the acquisition, and they picked up quite a bit of debt. They're unlikely to do that again. Obviously, you cannot buy the same company twice, but their growth, there's not too many other players they can buy in Australia.
So we can just assume the ratio and their organic growth.
Correct. Yeah. And remember, in this assignment, that's not 100% correct because companies do grow artificially, all right? But we just don't know what they're going to buy and how and when, right? So we cannot guess. We cannot just say, oh, they're going to buy Harvey Norman next year, right? It doesn't work. It's a good question. Right, so, and anyway, even you see the big change between coverage ratio from 28 to 21. Yes, that's because of good guys, but also if it's above 10, it doesn't matter. Because to have that much profit, to pay your debt 10 times, even if it went from 28 to, let's say, 17, 16, 15, as an analyst, I would be like, okay, they have no problem paying their debt. Zero credit risk, right? So if it starts going from 28 to like 5, yeah, you get nervous as an analyst. You're like, what's going on here? Yeah.
Sorry.
Yep.
JB Hi-Fi is actually a mature company.
Yep.
That has been operating in the industry for years. So
Yep.
let's assume there is a startup company, just a startup like
Yep.
Tesla or something.
Yep.
Maybe they got a low interest coverage ratio.
Yep. They would, yeah.
Is there something usually that this is not a good company?
No, nothing like that. So it's just it's a good question for those listening is, JB Hi-Fi is the question from the gentleman is, JB Hi-Fi is a mature company, but what if you were valuing a young company that's growing? Usually their interest coverage ratio is not 21, it's something like 5 or 4 or something like that. With Tesla, it doesn't have a coverage ratio because the company operates a loss. So the coverage ratio would be negative, and there's such thing as a negative coverage ratio, right? So in that case, the credit rating, first of all, Tesla is a rated company, so it does have bonds that are rated by S&P 500, by the S&P, which I'm not a big fan of the credit ratings. The problem there as an analyst is you would have to take a look at the outlook for the company. Of course, companies, especially young companies, are not stable. They're growing. Hopefully they have a good business. So you have to, as an analyst, assess, is the growth, is the both sustainable? Is the company continue to do well? And are they going to turn a profit eventually? And are the bondholders, is the company able to meet its interest obligations even during the losses? And if your assessment is yes, with Tesla, my assessment would be yes, because it's a capital intensive company. They need to spend billions and billions and billions of dollars to build the assembly line for the car. So they're not a small IT company with 3 employees, right? It's very capital intensive, so they're likely to have losses in the beginning and have problems with interest expense and therefore suffer losses. But when the company has been like that since the beginning, the company's never turned a profit. And the borrower still lent the money, knowing that, right? If my outlook as an analyst was positive and the company now is ramping up production of the Model 3 car, which is very exciting, and now it's breaking even. Tesla has broken even this quarter. And if your assessment as an analyst that's going to continue and people are going to continue buying the Model 3, the Model X, the Model S, the 3 cars in its fleet, and now the truck now, and full autonomous is going to work, and Tesla seems to be the leader in AI, in the artificial intelligence which is required for fully autonomous driving, then I wouldn't be that nervous about the interest coverage. But it would not be AAA rating if you wanted a rating. It would be something else. It would probably be a B rating or something like that. I mean, you can always Google it as well. Tesla credit rating. It's a good question. Moody's, not good. So Moody's rates it as B. So Moody's lowered its corporate family rating on B3 to B3. So B3, if we go back, so Moody's credit ratings. Let's go back to my slide. So B3 would be, so Moody's would be here. So it would be about so default probability 5.5%, so about 5.5% above the risk-free rate in the US, which is 1%. So about 6-7%. That sounds about right for the yield for these bonds, yeah. But that's again using a biased prediction, which I'm very skeptical of the credit rating companies. You know, when the financial crisis, this is the problem, right? Before the financial crisis, everybody, all the credit rating agencies, oh, we're the best, you know, we're the experts. Every time you hear a finance person say, I'm an expert, you know they're lying, right? It's always a bad sign. They're never experts when they have to say that they are experts. Buffett never says, I'm an expert, and he's the best, right? So always a guy. So all these three credit rating agencies say, we're the best, we're experts, we've done it for many years. And then financial crisis happens, and everything they rated AAA is worthless. And they're like, oh, no, those were just our opinions, right? Yeah, excellent. So not good. I'm not a big fan. JB Hi-Fi makes it easy for us, right? It's about 0.88% above the government rate. Where did I get these numbers? You might get these numbers I got from the textbook, but you can get a more updated version of those numbers in the file I provided. This file is downloadable. This data you can download. Where did I put it? Data, WAC. Is that right? Yeah, WAC. Excel, please. It's the macro, so I'll get some errors. So bond spreads here. So I actually downloaded those spreads. They're in his textbook. They're slightly different numbers because his numbers were older. I updated the data with the current bond spreads. So you can get the current, these are the bond yields. And using the yields, I show you here in this example, you can actually calculate the spreads. This is where I got the numbers from my slide. So it's just the spread above the risk-free rate, which is the Barclays risk-free benchmark, right? The Treasury. And then you've got the ratings based on AAA, BAA, BA, B, and then CAA ratings, right? And it's this minus that will give you the yield. So if you want to use the most updated number for the spread, this number here, you can calculate it yourself going into the data that I got you for. I got all the data for you, even for June and July. You can take this minus that will give you the spread, which will be lower because interest rates have gone down. But it's up to you. I mean, again, you'll get around that 3% for JB Hi-Fi. So it all sort of seems to point towards that cost of debt in your WACC. Yeah. Okay, so that's cost of debt, not too bad for JB Hi-Fi. Now the D and the E. The D and the E, there's a few ways to go about which one to use. The most obvious and the most commonly used is just use the current capital structure. So JB Hi-Fi does tell you that they want to keep a constant or a static or stable capital structure in the annual statement, which means we can just use the current capital structure here, number 3. But it's not a requirement. It's not a requirement to use the current capital structure, the current D and the current E. You can actually assume a capital structure that makes more sense or forecast it. Forecasting capital structure, very, very difficult. So let's have a look at these 3. So we can assume a target capital structure. The advantage is it's straightforward. We just make an assumption. The company should be 60-40, 60% equity, 40% debt, or 50-50. It's usually leads to a stable valuation because when you have a target capital structure, you're assuming that the company will stay at the target capital structure. And the capital management, realistically, the management team of the company does manage its capital, and it can always issue more shares or issue more debt to get to that target capital structure. The disadvantage is companies don't usually tell you what their capital structure target is. Sometimes they do, very rarely, but most of the time they don't. And therefore, the disadvantage is the valuation, your assumption of a target capital structure may be completely different. So that is the risk there. It's a big risk. That's why I would never do this. I don't like target capital structure and assuming, the company is currently 50-50. That's not good enough. Debt is cheap, right, especially now. And there's a tax benefit to debt. The company is going to be 80-20. And whether it's going to be 80-20 again, it could be. Yeah, it's a forecast. You could be correct, or something close, but it's too subjective for me. That's why I don't like it. Second, forecasting capital structure. Forecasting capital structure is not easy. So you can use a regression, you can use a model of some kind. In academia, we've tried that over many decades. We haven't succeeded in creating some kind of a model that works. And the problem with trying to create a model is that every company is different. By using a model, you can essentially, you're saying that you can on average predict it correctly, because all models work on average, right? And that's incorrect. Every single company is different. They have their own little quirks, their own problems, their own financing relationships. Maybe this company has a good relationship with a bank, so they get more debt at a lower fee, whatever it is. So I don't like using the model approach, a regression model of some kind or whatever it is, because it assumes that companies can be standardized. And companies are too heterogeneous. They're too different from one another to have some kind of a model that you need to forecast capital structure. So I don't like this. That's the problem there. I've always done this as an analyst, and I see this most of the time. 90% analysts use either they use this, and the other 10% I've seen a target assumption. And the target assumption is only because the company's debt is too low. It's only a matter of time before the company realizes it increases the debt. Because remember, theoretically, all companies want to maximize the amount of debt because it's cheaper, because you pay interest before debt. But you don't want so much debt that you face bankruptcy, right? Because debt is a contract. It doesn't matter if you have a bad year as a company, you have to pay your interest. And if you can't, you go bankrupt. So you want to maximize the debt to lower, because it's cheap compared to equity. Equity is more expensive than debt for a company, debt financing. But you don't want so much that then you go bankrupt because the interest expense is too high, because your debt has become so large on your balance sheet. So that makes sense. I've seen analysts do that say, oh, it's a matter of time before the management decides to increase debt and go from 80-20, 80% equity, 20% debt to something like 50-50. That makes sense. But most companies will tell you sort of what they want in terms of their capital structure. JB Hi-Fi tells us in the annual report that they want to keep a stable capital structure. So using the current capital structure makes sense. So what do you do there? So to get the D, you go to the balance sheet, the most recent balance sheet, which was released on Monday, and calculate all the debt that is included on the balance sheet. Trade and payables is not debt. Is not debt. Not debt, not debt, not debt, not debt, not debt, not debt. Borrowings, bingo, bingo. That's debt. Deferred revenue, not debt. DTL, not debt. Not debt. Not debt, but if you ever get confused, is this debt, not debt? Ask yourself, is the company paying interest on this? If the answer is yes, it's debt. If it's no, it's not debt. It doesn't matter if it's in the liability section of the balance sheet. Not everything in the liability section is debt, right? Most of it is not, obviously, here. So, but if the company is paying interest and the company tells you in note 17, note 20, paying 3% on this, that's debt, right? So that's the D. What about the E? It's just the current. Do not use for the E. Do not use the book value of equity, please. That's a big mistake. Remember, we want to use the market value of debt anyway, but there's no market value. It doesn't exist, so we have to use book, no choice, like I said on the lecture on Monday. For the equity, for the E, go to the file I provided for the assignment, go to the market value of equity, and go to the latest, most up-to-date number, which is about 2.7 billion for JB Hi-Fi. I give you market values for JB Hi-Fi, all the comparable companies as well. But for JB Hi-Fi, end of July, it's a $2.7 billion company in terms of market value. Market value, market cap, market capitalization, it all means the same thing. It's just the share price of ordinary shares multiplied by the number of fully paid ordinary shares is the market value of equity, right? The number of shares times their price. Ordinary shares. The company doesn't have preference shares, but other companies do. With market cap, market capitalization, it's always the value of the ordinary shares. Yeah. Okay, so we have the D, we have the E. Let's go to this formula. So we have the D from the balance sheet, E from the file I provided, T is 30%, cost of debt around 3%, cost of E using the CAPM, we're good to go. Yeah, that's good. Now, one last thing I want to talk about is these leases. This is interesting. Company has leases. And it has to have leases because, for example, even if it wanted to buy the location here in the Westfield, JB Hi-Fi, they can't. Westfield will not sell that location. You can only rent it. So it has leases. Now, those leases are part of its business. Without them, the company cannot do business. So technically, it's not really required, the right question, because it doesn't impact the value per share, but it impacts the ROIC. So you should do this. You should capitalize those leases. You should recognize capitalizing is just a fancy word of saying turning a cash flow into an asset. Yeah, like a house is, you got the rent, that's cash flow. The actual price of the house or the value of the house is the asset. So to estimate the value of a house, you capitalize the rental income from now to, let's say, 50 years to turn that stream of cash flow into a value. That's called capitalizing. With leases, you should capitalize leases for one sole reason, the ROIC. It doesn't impact the valuation, as I'm about to show you. The operating leases, if operating leases are capitalized, like it says here, this is from your textbook, there is a lease expense, right? Obviously, the rental expense for these stores that JB Hi-Fi has. There's two parts of the lease. Rental expense. One is an interest component, and the other is actually the lease itself. And the interest component is there because the alternative to leasing is buying. Even though JB Hi-Fi cannot buy, it can buy other locations that are not in Westfield. It usually doesn't choose to do that. It usually chooses to lease the location. So there's an opportunity cost when you lease that you still have because there's an interest component that you would have to pay if you bought the location. So what I'm trying to say is every lease payment has two components, an interest component and the actual rental or lease component. And by capitalizing, you need to spread the two. You need to divide, you need to separate the two. Luckily, this is not complicated. So why would you do this? You do it because, so when you capitalize a lease, the actual lease expense is broken up into an interest component, like it says there, and a rental component. It's renamed lease depreciation by accountants. It doesn't matter what the name is. But since depreciation is not related to capital structure, it's not, it remains it is an operating expense. Okay, that's not revolutionary. In ROIC, what will happen, this is revolutionary, is when you capitalize operating lease, the interest component is removed from NOPLAT. That's the numerator of ROIC because it's not operating. Interest expenses are not an operating expense. So it will increase the NOPLAT, that's true, but also it will increase the invested capital because you've capitalized an operating lease. You've actually identified a new source of capital. So you have equity, debt, and now you have leases, which is like debt. Yeah. Okay, so although these two effects counteract each other, so increasing NOPLAT, increasing invested capital, and you think, oh, they can just cancel each other, who cares? When you capitalize lease, the invested capital increases by more, so your ROIC will go down, and which makes sense. You do that because if you have a company that's leasing a lot, you would think, oh, it's generating all this income for not a lot of assets, because if you lease something, the actual asset value is not on the balance sheet. And you say, whoa, hold on, that's unrealistic. JB Hi-Fi is leasing a lot, it has all this profit, and invested capital is very small because it doesn't own any stores. That will give you a ROIC of, if you do that, the ROIC will be very high, 20, 30%. JB Hi-Fi is a retailer. It doesn't do anything. Its ROIC should not be that high. So one reason why, if you don't capitalize leases as an analyst for a company like JB Hi-Fi that leases a lot, you'll get a very high ROIC, artificially high. You can correct that. You can correct that problem by capitalizing. Let's have a look. How do you do it? The formula is not complicated. To calculate a capitalized value is just the rental expense of the lease divided by the cost of debt for your company plus 1 over the asset life of the lease. This calculation is done for you in KGW. I actually did it here in the historical drivers. That's what this formula does. Right? And you need to enter in your lease expense, your interest rate on the lease, and the life of the lease, the average life of your lease. So how does it look in terms of balance sheet? So imagine prior to capitalizing, the income statement, the balance sheet looks something like this. You got revenue, you got expenses, you got a rental expense, the lease expense here. Right? Your balance sheet, as you can see, it's just debt and equity, no leases. Yeah? So your assets is quite small. Right? But the value of these leases is not small. Using this formula down here, it's from your textbook as well, you would be calculating the value of the operating lease to be quite high, 700 million, 720, just based on these rental expenses. Right? So how does that impact the ROIC? Let's have a look. When you capitalize, this is how your income statement changes. It goes from what you saw before to suddenly rental expense being renamed into lease depreciation. So in other words, that rental expense is split between the interest component and the lease component. The interest component is removed from NOPLAT because it's non-operating, but the lease depreciation, the lease expense, is an operating cost. All right, so it continues to be included in your NOPLAT. All right. Don't worry about the RECs. Look at this. See the ROIC? Down here at the bottom. See the big change? Basically halves. Your NOPLAT increases, so you think, oh, ROIC should go up, right? NOPLAT increases after you capitalize. It does, but the invested capital increases by more. Let's have a look at it. Your invested capital goes from something like this, which is just 2 sources of debt, 2 sources of financing. Now it's 3 sources of financing. You add those capitalized operating leases, ba-boom. Look at that increase in invested capital, massive. This example that's from your textbook has a company that has a lot of leases. The invested capital goes through the roof after you capitalize using that simple formula. Your WACC changes completely, right? It goes from being at 25.75 to 10, 30, 60. Most of the financing is actually coming from all these leases the company's operating. The WACC decreases a lot. So you think, hold on, the valuation should change. No, the valuation still stays the same, right? Before the leases is here, after the leases is here. After you make all those adjustments in the previous slides that the example shows, the valuation does not change. So you think, well, who cares? The only thing that cares is the ROIC. So the valuation is the same. It does not impact the valuation because essentially it's just financing. Financing has no impact on the valuation of a company, shouldn't at least. But where the only impact, this is why you should capitalize your leases, especially for a company like JB Hi-Fi, the impact is on the ROIC. It goes from being unrealistically high to something that's more realistic. In KGW, once you enter in some numbers here, let's just put in some dummy numbers, 5%, let's say 5 years. It will calculate that historical capitalized lease value. This then goes to this section of the forecast drivers, and you then have to forecast the increase in the capitalized leases, which you should grow at the growth of revenue that you're forecasting, which makes sense. More revenue means more stores, and the frequency of the growth should be with revenue. So you grow that at the revenue, just link it to revenue, just boom, multiplied 1 plus the revenue, nice and easy. And then have the interest rate, like I told you in the previous workshop notes, have it constant. It's not the best forecast, but the company usually doesn't tell you their lease. Oh, maybe they do. Maybe the lease. I didn't find it, but if they do, use that. Yeah, or use my number. My number comes from a friend who actually leases a restaurant here in Westfield. So Westfield charges you a lot, by the way, a crazy amount. His annual rental is 1.25 million per year for a restaurant. So I know those lease rates are not small. They're not the cost of debt. They're not 3%. They're basically double that. Westfield is one of those places. When you have a restaurant or a store in Westfield, you have guaranteed foot traffic because it's a big shopping center, and the company knows that. The Westfield knows that, so they charge you, right? So double the interest rate. The cost of debt may seem excessive, but it's actually quite standard. Not all JB Hi-Fi locations are in Westfield, so you can. That's why it's sort of 5% makes sense, because it's a little bit cheaper outside of a shopping center, but it will be higher than the cost of debt. Now, the only other thing I want to show you is your other claim. When you capitalize operating leases, as you should for JB Hi-Fi, you should have capitalized operating leases here. In your WACC, just like in the example. You should have that lease rate of, let's say, 6%. It is tax deductible. Interest rate, your lease depreciation is tax deductible because it's an operating expense that is calculated before tax. So just like debt, it is tax deductible. And the proportion of those leases, the capitalized value, should be a percentage, right? So you should have three sources of financing for JB Hi-Fi. You will have equity, let's say 80%, 10% debt, 10% leases. I'm just making up numbers, and the proportion is this divided by the total. You can lock it if you want, fill down, and for equity, let's say we'll get something like 6%. Voila, you have a WACC, right? These are just made up numbers.
Is there a capitalized lease shown on the balance sheet or still?
It will show on the balance sheet, but KGW will do that for you, because when you enter the capitalized leases here and forecast from 2019 to 2023, it will include capitalized leases here in the balance sheet for you already. So you don't have to do that. The model knows that. It does that, all that for you. So like in this example, it's added. Where is it? It's added here. It all does that for you. KGW does all that for you. It's a good question. And we're at the end of the lecture. I don't have time for the workshop. Let me just go to the notes. It was a pretty quick one, though. Let's mention some interesting stuff. I still have 8 minutes. So operating leases I just talked about. This is important. Yes, this I want to talk about. So after the income statement, you have this statement of comprehensive income. You have usually something like a cash flow hedge adjustment or some exchange rate difference adjustment. All that should be entered in KGW in the historical data. Wrong file. There is a section called Statement of Changes in Equity, right? And one of these gives you those foreign exchange rate adjustments. So you can use row 40 for all of those. There are only two on the balance sheet, on the comprehensive income statement here. So you can add them to, you can add that to, and enter that in via row 40 in KGW. Yeah. You can rename this even if you want to, whatever you like, or you can leave it. You can rename it to changes in fair value of hedge. Actually, I would probably not rename it because that's exactly what it is. The name is correct. So like it says here, the other comprehensive income adjustments, foreign currency, cash flow hedge, any income tax benefits as a result for other comprehensive income are not entered into the historical data tab via the income statement, but via the statement of changes in equity only, please don't double count, only, which is row 40. Next, the net income. So I got a question after the lecture, I think. How do we know that the student was asking, my EBITDA is different to what JB Hi-Fi says? That's fine because you may have classified things differently, or KGW is forcing you to classify things differently compared to the annual statements. But you just look at the net income to make sure that's the same. So row 28 is the same as the profit attributable to the owners of the company. That's your check, if you like. DTA, DTL, so there are non-operating assets, deferred tax assets. There's quite a few. I think there's, let's have a look on the balance sheet.